There's only one game in town here this morning, and it is, of course, the tariffs and the array of tariffs that we've gotten in the last couple hours or so from the U.S. as we count down to this tariff deadline of August 1st. And we are starting to see, right, some surprises, Dave. Taiwan, 20%, Switzerland, 39%, and certainly a 10% blanket on everyone else, maybe that the U.S. doesn't want to talk to.
Yeah, there's a minimum of 10 right now. That's going to be the baseline across these markets. As Yvonne is pointing out, we are looking at some surprises here. Canada was jacked up to 35%. We're seeing market reaction right now. The dollar is steady. Equity markets still are on the back foot. Korea is down 3%. Taiwan is coming online in a couple of minutes, if not already now. And we are expecting to see some pressure there. You're watching The China Show. Good morning. Welcome to the program. The Friday session just under 30 minutes away. The next 3 hours will be quite critical as we approach that deadline, and 7 days after that deadline. So around this time next week is when the tariffs, which are starting to form in more clarity right now, will start to take effect. Markets are already reacting. As you can see, some of the markets like Korea, for example, Taiwan is coming online 1.4% to the downside. Singapore coming online, unchanged there. Flip the boards, please. Gold futures, which were higher at the open in the early goings of this Friday, are now seeing a bit of downside now. U.S. futures, as you can see. And, of course, we're also looking at Europe specifically, because when you look at Switzerland and how that specific market is actually weighted towards pharma and pharmaceuticals, we'll see what that looks like. 39% tariffs as far as that is concerned. Right. It's an ongoing and fluid conversation as far as Taiwan is concerned. We'll get you more details in a moment on really what perhaps the possibilities are, although we are working with the assumption of 20% and possibly maybe even lower. We mentioned gold. Bond futures are on the way down, so as you can see, yields are biased towards the upside. Currency markets are doing this. In about 10 minutes or so, we'll get the fix coming out of the PBOC, and that will be critical as far as maybe providing some short-term support for these markets. In fact, the reason I bring that up is on this next chart you're seeing on your screens right now. Dollar China, for the first time in several weeks, has a 720 handle it, given the first positive month for the dollar this year, and we are set for the dollar's best week, get this, in 3 years.
It's interesting, this whole big macro story. What is leading to this breakout in the dollar, right? Obviously, what we heard from the Fed and what we've been seeing in that inflation print overnight, so they did kind of lead things higher for the dollar. But then again, the big question today is, are we entering to this new era of higher effective tariff rates right now? Things have to settle still. It seems like right now that number is still slightly lower than or higher than pre-Liberation Day. Yeah. But still, when you talk about baseline is still 10%. Initially, the threat was 15%. You got to wonder, did Trump actually chicken out? Maybe or maybe not, right? There's still a lot of questions on that. But we're going to break it down country by country as much as we can in the next 2 hours or so.
Yeah, there's a lot of confusion going on because lots of new numbers have come out as well. In fact, there are new numbers, and then some of the commentary that's come through so far is based on ongoing negotiations. There is still room to bring some of those numbers down. Like Taiwan's a good example. Thailand, 19% that's come out, and what they're saying is, and this is funny, you take a step back, and Thailand is saying, because of our good relationship with the U.S., we're only getting 19%. It's
a win for them.
And that's a good thing, to your point, right? Equity markets are up 25% since Liberation Day. So they priced out worst-case scenario on a trade war. But you got to wonder, have they completely priced out all the risks, right? And a lot of the commentary that's come through so far is this does open up some downside over the short term as far as these markets go. And downside is what exactly we are seeing going into the Friday session here today.
Yeah, let's unpack all this right now. All these tariff headlines. We're joined by Rami Varghese in Sacramento. Also, Min Min Lo joining us here right now in Hong Kong. Avril Hong is also joining us from Singapore. Rami, I'm going to start with you. We got a whole slew of news here, and we're trying to really kind of break down what this means. What are the motives and rationale behind some of these tariff rates? Are we finally getting some resolution on what Trump is doing with tariffs?
I think certainly we have seen some resolution. We know what our global minimum is. That's 10%. We saw a slew of tariffs for various countries. But we still have a lot that's outstanding. The biggest one is China. We still don't know how that's going to settle. They have an August 12th deadline for that truce, and that I would think is a really huge thing that's looming over all of us and equity markets, to be frank. And of course, we have Mexico, another key trading partner for the United States. Mexico got a 90-day reprieve. So yes, we did get a lot of clarity. We got our 10%. We've got 15% for other countries that have a trade surplus. We've gotten like some very interesting rates for Switzerland and the Philippines, and we had already seen what was going to happen with Indonesia and India and South Korea. But again, there is still a lot more that we need to have clarity on, and today is not going to be the final day when it comes to Trump and his tariff policies.
Romy, David here. I mean, speaking of question marks, the big one I have in my head is Canada and 25 to now 35%. What's going on there?
Yeah, Trump is not treating his North American neighbors equally. We got a 35% rate for Canada, which is higher than the 25% from before. Meanwhile, Mexico, as I mentioned, gets a 90-day reprieve. One thing that's pretty clear, though, is that there is a big exemption for Canadian goods because goods that are traded under the U.S.-Mexico-Canada Trade Pact are exempt, and that is a huge relief for Canada and its Prime Minister, Mark Carney. I mean, obviously, a higher rate of 35% is a big disappointment, but for now, the bulk of goods are being traded under this North American trade agreement. And that really makes the effective rate for these goods a little bit above 5%. Of course, we still need to find out what's going to happen with these sector-level tariffs, the so-called sectoral tariffs. And again, as I mentioned, there's still a lot of uncertainty about that.
Min, I'll get to Taiwan. They say that 20% tariff rates are temporary right now. Seems like they still want to negotiate.
Yes, obviously they're not satisfied given it is higher than what Taiwan's rivals, South Korea and Japan, had gotten 15% there. But Taiwan got the 20% rate, and they're saying this is just temporary. They want to continue the next round of trade talks. They want to lower tariffs further, and in particular, they want preferential rates on chips. Because remember, there is still the Section 232 investigation into semiconductors. If there are more sectoral tariffs, that's going to be a big hit to TSMC and the Taiwanese economy. And this is despite all the signals from the Taiwanese government that it was willing to buy more goods from the U.S., including agricultural goods, energy products, military equipment. The Taiwanese president has pledged to invest more in the U.S., but this is coming against the backdrop of the U.S.-China trade talks happening at the same time, and the reports coming out of the FT that the U.S. was not granting passage to Taiwanese President Lai Ching-te to stop over in the U.S. en route to other South American countries. So raising the question as to whether or not the U.S. is going to trade away Taiwan in the interest of this broader trade talk with the U.S. And of course, for the exporters, it's going to be a big hit, not just because of tariffs, but also the appreciation of the Taiwanese dollar, which has gone up by about 9% against the U.S. dollar year to date so far.
Yeah, April, let me bring you in. The idea of U.S. allies is a fluid one in this discussion. We just heard, Trump is treating North America as separately, Mexico, Canada. Min just pointed out, of course, the nuance in the Taiwan story. You've been looking at the winners and losers here and really how these three buckets have so far emerged, David. What can you tell us?
Yeah, I mean, being an ally of the U.S. or having that really close relationship is no guarantee of a lower rate, to your point. So you can kind of separate it into three buckets to think about things. You have on one end of the spectrum, the ones that are being hit by the baseline 10% rate, so kind of winners in a sense. And then the losers, right? You talk about Canada with 35%, even though the economic impact might be quite muted because of the USMCA exemptions. And then Switzerland as well. This is a much higher rate than was previously threatened. And you talk about the pharmaceutical sector and how that is a key product of export to the US. So that's something that has already been playing out in currency markets. And then think about maybe closer to home where I am in Southeast Asia, right? Where you have the likes of Thailand and Cambodia that were in the midst of a border conflict. So the worry was that they would be slapped with 36%. Now they're getting 19%. This is seen as a good outcome. But for Malaysia, that when I spoke to the trade minister in May, thought that 10% would be a good outcome. They're also getting hit by 19%. And then, as I mentioned earlier, when it comes to sort of the winners in all this, the ones that have been, secure in that baseline tariff rate because it's not at 15%, which was earlier what the worry was, like Singapore. This is also seen as a good outcome. Remember, the likes of Singapore, they import more goods from the US than they export. So that's one way of looking at the winners and the losers as these tariff announcements come in.
Team, thank you so much. Romy, Min Min, and April there, of course, on all the different facets of this ongoing and very fluid developing story here. Thank you so much for that. Going into the open, 20 minutes away here, the opening bell in Greater China. Just to note, of course, one market we have been tracking very closely is South Korea. And as you can see, we're off substantially in that market. Capital gains tax is what we're pointing to there. We're down 3.7%, fittingly, but coincidentally, the biggest drop since Liberation Day back in early April. SK Hynix, Samsung Electronics really leading these declines to the downside, down about 6% on the Korean chip maker. Right.
Yeah, we're still going to talk about trade coming up here. Speaking to the former U.S. Undersecretary of Commerce for International Trade and former U.S. Ambassador to Singapore, Frank Lavin. We're counting down the opens of trade in Shanghai, Shenzhen, Hong Kong. This is The China Show.
Earnings season is here.
The earnings are front and center. A slew of results already out.
Are tariffs going to eat into margins?
Bloomberg is first to break the numbers.
JP Morgan, Citi, Wells Fargo, Bank of America, Goldman, Morgan Stanley.
I'm getting my spreadsheets ready.
With the smartest insights.
It's going to be a can-kicking situation.
Expectations are relatively low.
The market is looking for confirmation of that growth narrative.
Continuing coverage on Bloomberg. Context changes everything.
Good morning and welcome back. You're watching The China Show. The opening bell just 14 minutes, 16 minutes away, give or take here. The renminbi fix of the day is coming out in a couple of seconds. Estimates bottom of your screens. We are trading at about those estimates, but so far we have had a fix for the most part of July, roughly anchored and welded around the 715 handle. If we get something on the stronger side, or a stronger bias at least, that might provide a floor for risk assets, which are clawing for some anchor, some stability as we go into the session today.
It was interesting when we saw with the S&P, right, just towards the end of the trade, that where basically we lost about a percent of gains leading up to the month end and the like there. And what's really kind of driving that certainly is going to be one thing. But certainly in this hour, it's really been about Trump and tariffs.
Yeah.
And really what does this mean in terms of U.S. trade policy moving forward? Joining us now is Frank Lavin, former U.S. Undersecretary of Commerce for International Trade. Frank, it's always great to have you. How do we look at it now, right? Is this really something that we're seeing is still negotiating tactics, horse trading, or are we actually starting to see the entering this new era of higher tariffs and higher trade barriers?
Yeah, thanks first for having me on, Yvonne and David. Good to see you. Look, I think we're getting to the finish line on this very aggressive Trump initiative that started with Liberation Day and putting all of the U.S. trading partners on the back foot and hitting all of them with a real tariff shock and then threatening even more tariffs and then sectoral tariffs on steel, aluminum, copper. But he's gotten a response. He's gotten a response and he's worked out new trading range with most of U.S. trading partners, China being, I think, the largest exception so far, but even that is working its way to a finish line. So I think we're really seeing the dust settle. I think we're seeing the temperature drop a bit. I think we're seeing a return of stability. I would predict there's still going to be one more twist in this. There's still going to be one outlier. It might be U.S.-Brazil because there's personal animosity there. It might be Canada because we've seen Trump give them a sharp elbow, but there's still one or two outliers that are left. But in general, the situation is moving towards stability and what the U.S. business community wants, predictability.
Frank, David here. To the point you just made, it's certainly helpful for everyone to have clarity, and we are getting to the end of this specific tunnel. Do you think the president, though, has achieved his objective, which might be different from simply tariffs? What was the end objective, and whether or not you think that was achieved?
I think that's the point that we might not see a good answer to for months, David. I mean, I think it's fair to say that Trump in general has prevailed in the sense that he has gotten most of what he wanted. He's looking at asymmetrical tariffs. He's putting the sort of a mercantilist trade policy front and center, that the U.S. is promoting its exports, and it's putting a higher cost on other countries' exports to the U.S. So he's prevailed in terms of getting what he wants. But has that helped the U.S. economy? Is that going to improve our growth rate, or is it going to improve unemployment rate? I think that's very much an open question, and I personally don't see it. I think he sort of won in the sense of getting his goals, but I don't see adding those extra costs to U.S. business as helping, and I don't see any real reshoring taking place.
Where should we expect effective tariff rates to settle then now, Frank? I think Liberation Day was around 30%. What's sort of that number now, you think?
Well, it's country by country are these new rates, and it's 15 seems to be the common rate. There's still a big question mark where China's going to end up. And I think, as you noted in the previous segment, Yvonne, what's really interesting is how many carve-outs there are. So he's talking about, he added a 50% tariff onto Brazil, but then he carved out aircraft parts, orange juice, and a lot of other sectors. So I think the effective rate, the posted rate, so to speak, might be at 15%. Or a little higher for some countries, but the effective rate might be significantly lower. It might be 10% or even in the high single digits.
Frank, where do you think the grand deal with China, I'm carefully phrasing that instead of just simply a tariff rate, the grand deal with China ends up, and how do you think that's going to look?
Well, I think there'll be some improvements in U.S. market access. I think the U.S. is going to have these asymmetrical tariffs in place. And the real question is, to what extent will the U.S. tariffs on China be higher than those imposed on other Asian trading partners? Because it's really a competition among them for U.S. investment and primacy in U.S. trade architecture. And I think China is going to come out somewhat on the losing end of this, meaning the good news for China is the dust settles. The bad news is if Japan has a lower effective rate or if Taiwan has a lower effective rate, then that's bad news over the long run for China.
How should these nations be thinking now? Should they just settle with these rates, Frank, or is there a way to look at what happened with China, right?
Oh, sorry.
Okay. Because I see what happened. No, I was going to ask you, because China was perhaps the one that really kind of stuck their neck out with reciprocal tariffs. And they got what they wanted in some ways, right? Yes, they have the leverage of rare earths. They certainly use that. Do other nations have that kind of leverage to do the same?
I don't think they do have that kind of leverage, and I don't think they have the appetite for a long-term friction. And remember, Korea, Japan, and Taiwan all have very strong security concerns and a security relation with the United States. So they just don't want an open-ended spat, an open-ended friction in that relationship, because more important is keeping that defense relationship going. So they moved to settle very quickly. China's got more of a sense of nationalism, and it certainly doesn't have any kind of security relation to the U.S. So they're in more of a position to push back and more in a position to be a bit difficult, and they don't mind enduring several rounds and 6 months of back and forth to get this solved. So they just have greater capacity to push back, but the other countries don't.
Frank, just to circle back, and I want to get your thoughts on why, on Canada specifically, what do you suspect took place there? Why do you think we went up to 35% with Canada?
It's a little hard to say, because Carney had always been very sure-footed in his dealings with Trump. There had been nothing inflammatory or off the top of my head, because remember, Trudeau got in some occasional spats and there's some back and forth. But I don't think Trump's got a chip on his shoulder about Carney. The one item that Trump did invoke in the last 24 hours, that Canada stated it was prepared to grant diplomatic recognition to a Palestine state. Now, Canada had some conditions on that. It said if if the Palestine state has elections within a year. So it was not unconditional support. But that did irritate Trump to the point where he raised it as a concern of trade issues. And he's raised, remember, he raised an issue with China of China's support for Russia and Ukraine as an issue. He's raised in Brazil their domestic politics, where the Brazilian government has jailed Bolsonaro, and that upsets Trump. So he doesn't have a problem about injecting sort of side issues that are not directly related to trade into these talks.
Frank, what else should we be looking out for? What's still coming, right? I think of one thing, maybe exports that are transshipped. I'm also thinking sectoral tariffs. What should we look out for in those two fronts?
Well, I'll tell you, there's several other elements you mentioned too, but the other point I'd look at is Trump is providing a very strong incentive for other trading partners to seek their own trade arrangements with like-minded nations. So I would not be surprised, for example, if the EU moves forward very aggressively with opening up trade with other kind of countries that are concerned about Trump's volatility and these new tariff rates. So I would not be surprised if as we get into next year, that the EU is announcing some new deals, say with Japan or other trading partners, because what they're really saying is U.S. no longer represents that stable force for market economics that historically has represented.
Frank, thank you so much for the time, and our apologies if we've interrupted any of your evening plans there. Thank you so much for coming on fairly last minute, and we'll see you when you're back in town, Frank Lavin, their former U.S. Undersecretary for Commerce and International Trade. Right, going into the open today, declines, as you can see on the Hang Seng Index in the early goings. Asia, we're down 6 straight days. That is now the longest losing streak so far in 2025. The open, 7 minutes away. You're watching The China Show. Good morning. Welcome back to shows. We're looking at turnover closely today. Nearly $2 trillion yesterday, and that's important because we almost had a very, very steep sell-off going into the close, 1.8% on the CSI 300, accompanied by fairly strong market activity. Keep an eye on that. A lot of sectors to watch today. Solar, chips, brokerages are going to be very much in focus, given, of course, the Asia conversations, or that path towards IPOs here in Hong Kong might be slightly more stringent based on some reporting out there. Earnings, and of course with Hong Kong GDP coming out later today. So yeah, lots to consider going, with the exception, of course, of all the other things, of course.
Morgan Stanley saying this improvement in Chinese stock sentiment may not hold. That the sustainability of the recovery remains in doubt here, flagging, despite this turnover, we expect swings in market sentiment as overexcitement towards anti-involution. There's that name, buzzword once again. U.S. futures are slightly to the downside here today. So is Europe. We're watching very closely what happens to stocks in the pre-market in Hong Kong. What's really kind of big? The big one is NEO shares, right? So we saw what happened in the ADRs. They jumped after the official launch of its Onvo L90 model. There you go. The stock jumping there in the pre-market. We're up about 8.7%. 7.21 for dollar China. The open is next.
Good Friday morning from Hong Kong. 40 seconds to the opening bell. Looking at some pressure across equity markets, cash markets, futures. Some uncertainty. Well, first, some certainty on tariff rates. We understand there are some negotiations taking place still up until the 11th hour. Of course, we're counting down to the deadline, which is in about just over 3 hours from now. And of course, you count 7 days after that deadline for when these things will take effect. We understand Taiwan will be holding a briefing in about 2 hours from now. Keep an eye on that. Among many things, of course, it's a fluid conversation. Equity markets are poised to open lower here, Yvonne.
Yeah, and you are seeing a modest reaction to some of these tariff levels and what we've seen so far, though. That's one thing to stress, maybe because a lot of it has been priced in when you have big deals like Japan, South Korea, EU. We're already kind of set in print there a few days ago. So maybe a lot of this has been priced in already. But there were some surprises, right? You talk about Taiwan at 20%, still higher than North Asia. Switzerland at 39%. Canada now hit with 35%. So we're still kind of digesting what this all means. What is the rationale behind these higher tariffs on some of these nations here? But onshore markets, though, we still continue to see another day of losses there, right? So Dave mentioned that 1.8% drop in the CSI 300 yesterday was quite telling. Laura Wang and her team at Morgan Stanley is saying this equity rally, it remains in doubt now, the sustainability of this rally, because it seems like all this overexcitement, they say, on anti-involution is going to make way now for macro weakness, right? We saw the PMI numbers in July. They were weaker. You saw the Politburo readout. Nothing came out in terms of large stimulus. And they're still talking about these tensions between the U.S. and China, which the market continues to underprice as well. Keep in mind, there's still no deal between U.S. and China. We still got 12 days to deal with that. So there you go. That's the sentiment there, that maybe things are starting to peter out despite turnover being strong. Maybe that's why we are seeing things peter out a little bit here today. Once again, Shanghai Composite is now just below that 3,600 level here. We're watching, of course, what happens with the likes of the miners and also the commodity space. Iron ore is catching a slight bit. Steel, though, has been seeing a bit of a pullback here this morning. And we're watching very closely how Hong Kong fares here. We talk about the fix as well, right? So 714, so it's still looking pretty steady, but it didn't quite reflect the recent sort of strength that we're seeing in the dollar. Right? So maybe this is providing an anchor from the central bank on the currency right now as we wait for some more sort of tariff clarity. But there you go. Hong Kong doing a little bit better here today. We're seeing HS Tech is up about 0.4%. A property is on offer, but we're watching the tech names and we're seeing a bit of a recovery there from yesterday. Alibaba's up 2.5%. Baidu also up about 2% here. Meituan still, relatively speaking, not doing as well. But yesterday we certainly saw a big move there on what Prosus did in selling that stake. In terms of the EV space, that's a big one here today. Perhaps that's why we're seeing HS Tech a little bit elevated. It is about news on NIO. So the ADRs jumped overnight on this new Onvo L90 launch. So,
L90, yeah.
Yeah, so it seems like the pricing, people say, is competitive. There's some pretty interesting internal features. I haven't looked it up yet, but it looks like it's pretty attractive. So there you go. Stock up some 9%, Dave.
Yeah, there we go. That's after I think the stock fell quite sharply this week. Okay, a couple of things that we're tracking, as Yvonne is pointing out. So stablecoin legislation, who gets the license, number one. We talked about the fix, and as Yvonne underscored there. The nothing to see here in the fix is almost something to see there, as you underscore the anchor that's provided so far. Number one. Number two, and earnings, of course. We talked about turnover already. In terms of sectors, so Apple suppliers, earnings came through. Some decent guidance, and as well as how Apple described the Chinese market. They did see an acceleration of growth in the Chinese market. We're looking at brokers today. The reports out yesterday, which the market had already reacted to, but of course this is something that we've been really bullish about here in Hong Kong, is the pickup in the funding market. And it might, based on the reporting, China's eyeing tighter A-share firm listings here in Hong Kong. In terms of data, GDP is coming out later today. Keep an eye on that. And property, in case you missed that, also very important here. The home slump deepened with the value of new home sales. So every month, the top 100 developers come out with an aggregate number, and again, down 24% from a year back, just to underscore the point Yvonne was making and the point Morgan Stanley was making. The fundamental story remains challenged in mainland China. On that very note, let's bring in Mark Cranfield. He's with us out of Singapore to talk us through the market action today. Mark, risk aversion, not a 1 or 2 sigma move, but how would you contextualize the move down we're seeing in equity markets this Friday?
I think when we came into this week, we knew there was a lot of risk events building up, a lot of big earnings numbers, and markets, particularly the US equity markets, trading at very high levels. And I suspect that what investors are doing here is they're saying, is there really any more good news to price in here? Especially when we finally have the trigger of all those tariffs being put in place, something which we've been waiting for, we've been discussing for a long time. And here it is in black and white. The reality hits home. The tariffs, maybe they're not as big as they were expected to be earlier in the year, but it's something we can no longer say is coming. They're here, they're going to happen. And maybe that's the catalyst when markets are already pretty richly priced. So it's pretty telling if you look at the way we've had stellar earnings from a whole host of the major tech companies in the States over the past 2 weeks. Alphabet, Microsoft, Meta, Apple, all doing extremely well. Amazon was a bit of an exception. And yet when we came in this morning, NASDAQ futures were extending losses seen late in the session last night. And if you look at what's happening in Asia, one of the star performers has been the Kospi, and we've gapped much lower in Kospi, and we're heading south. Again, a market which has had an exceptional run since April. So it looks as though investors are deciding, we've priced in so many good things already, you better show us something even better. Otherwise, we're just going to take our chips off the table for a while, especially when we've heard that the Federal Reserve is in no rush to lower interest rates, which was one of the things that was fueling so much of the optimism in markets in recent weeks.
And it seems like it's almost fueling the dollar and what looks to be a breakout in the dollar now, Mark. We're talking about set for the best week in 3 years. What do you think is driving that and really can it continue?
If you look at the short term of the US curve, a lot of people use the futures market. The curve there is the way they price short-term rates in the United States. Over the past 10 days or so, it has skewed quite dramatically in favor of higher US rates. That doesn't mean to say that people expect a rate hike in the United States, but they certainly no longer expect any rate cuts anywhere near coming in the next few months. So there's been a significant change in sentiment that helps the US dollar a lot. In fact, the parallel with dollar yen is very clear. If you look at the performance of dollar yen going above 150, the change in the short-term interest rates in the United States, it's a very clear correlation between the two. And what happens with the yen obviously feeds over to other major currencies as well. Interestingly, the Swiss franc is a big underperformer today, and that in the past has been a funding currency. Well, currently, the Swiss franc offers more than 400 basis points pickup for people in US dollars. So once again, they may start to look at that, particularly as Switzerland received much bigger tariffs than were expected, 39%. So we're back into the realm where people might start thinking the dollar is good to be a carry currency. There's obvious targets in the yen. Bank of Japan kicked the can down the road a long way. They're not going to be raising interest rates anytime soon. The US is on hold. Switzerland recently cut interest rates to 0. So once again, the yen and the Swiss franc look as though they're good currencies for people just to hold in terms of shorting them against the US dollar.
Mark, thank you. Mark Cranfield there, MLI strategist there, highlighting what to really watch out when it comes to these markets. And really, we're focusing on one market as well this morning, and that is Taiwan. So we did get this effective rate now, talking about 20% for Taiwan. The initial threat was 32%. So, yes, it is lower than what was initially sort of, facing. But then again, still higher than some of the North Asian rivals like the likes of Japan, like the likes of South Korea. We're waiting for, of course, this press briefing from the Taiwanese at around 11:30 a.m. local time. So that's about 2 hours from now. Let's bring in Jason Hsu, senior fellow at the Hudson Institute. He's a former legislator at large in Taiwan's legislative yuan, and he joins us now from Washington, D.C. Thank you so much for joining us. Certainly, there's a lot to digest here right now, but 20% tariffs there from Taiwan. Would you see this as a win or a lose for the island?
Well, at face value, it's bad, but strategically, it's manageable. It's bad because exports face cost structure, industrial output might decline, and economic planning becomes uncertain. However, if Taiwan can negotiate a bilateral deal quickly, mitigate the tariff through concession offers, through investment, procurement, or secure more meaningful trade concession from U.S., the scenario could transition from punitive to constructive. So we have to wait and see how the Taiwan team react and respond in the next few weeks, and to see if they can turn the table.
Yeah, Jason, David here. In fact, to the point you made, they describe this as quote unquote temporary. Do you think negotiations are still taking place right now?
Well, it is somewhat set at 20% for the time being, and there will be some short-term pain. It's substantial with export-heavy industry facing higher barriers, but there's also bargaining potential. First of all, Taiwan's been non-retaliatory posture, offering greater U.S. imports, tariff elimination on U.S. goods. That has been sort of in the core of the trade negotiations. And if Taiwan can continue this framework on the particular strategic sectors that U.S. care deeply about, such as defense offset as well as LNG procurement deals, and this could ease the barriers that U.S. is now taking a lot of stock about. Yeah.
Jason, what should I look for in terms of, Section 232, these sectoral tariffs, right? That still remains the question mark. There's been probes into semiconductors. Do you foresee any sort of further tariffs when it comes to chips?
Yeah, I mean, it's negotiated separately from the reciprocal tax, and it's obviously an issue that President Trump does not want to tangle with tariff negotiation. And you can see that the chips are not included in this round of tariff announcement, and it becomes a leverage point for both Taiwanese government and as well as the Trump administration. And we'll see how two sides use this point of leverage well to each other. And the way I see it is probably Taiwan is in a weaker position of a negotiation in terms of Section 232, as TSMC already come under scrutiny of the SoftGo case, and that is subjected to a large amount of fine. And so this Section 232 is becoming a big issue. And I know for a fact that Taiwan negotiation team is trying to lump in Section 232 as part of the compliance deals that Taiwan is negotiating on behalf of a semiconductor sector.
Yeah, and Jason, I'm going to quote this report from the FT this week of Donald Trump said to be blocking Taiwan President Lai Ching-te's New York stopover. The reason I bring that up is you mentioned leverage and the notion that Taiwan has been deprioritized by the U.S. in favor of talks with China. Do you think that notion makes sense in your view?
I think it's quite a concerning signal because it seems Trump is shifting from a strategic principle to a opportunity-seeking a deal-making situation. And this concession to China is a signal and warning to Taiwan's leadership. And it must be taken seriously. And knowing that Taiwan's leader in stopping over U.S. is protected under Taiwan Relations Act. So that is to say that the Taiwan Relations Act stipulates that the leaders can stop over, and U.S. should allow the transit and assist stopover in the U.S. And the fact that U.S. backed out on this has been seen as a rejection to Taiwan's right, and as well as a deviation from Taiwan Relations Act. And this could also further be seen as a concession to China's requests in order for U.S. and China to reach a deal, and that it still has nowhere to be seen yet for the moment being.
Yeah, that certainly is interesting, right? I have to ask you about what the impact on exporters is going to be.
Yeah.
Given the fact that, yes, it's a higher tariff rate than some of its peers in North Asia, you also have to add on an 11% gain in the currency against the U.S. dollar this year. How big of a hit is this really going to be on Taiwanese exporters?
So, as I mentioned earlier, the semiconductor so far is being discussed separately, but the other sectors are going to be hit quite significantly. The ones that are hit, including electronics, ICT, and telecom hardware. And this is somewhere between 3 to 5% range output. And it sounds little, but then considering that there are hundreds of thousands of small and medium enterprises that are working in this sector. So it's significant from the individual company's perspective. And secondly, it is the industrial machinery and steel and heavy manufacturing metal products that will be hit. And the contraction for the output is about 5%. Although that is already a correction from a higher contraction if it were to be imposed on a 32%. And this would also increase the burden on the U.S. buyers as U.S. buyers buy more ingredients from Taiwan. And thirdly, are consumer goods and textile and agricultural products. And these are the sector, although the total volume is smaller, export to the U.S., but the impact is probably the biggest. It's estimated to be at 10 to 17, reducing contraction for that matter. And so overall speaking, GDP growth would be down or slow by 1.2 to 1.6%, with the current 20% imposition of tariff, and then compare with 3.8% if it were to be a 32%. And manufacturing sector contraction is probably something to be most concerning to Taiwan's economy. So it will be around 5% under the current 20% tariff. And a few months ago, when the first round of tariff was announced, Taiwan already announced a 77 billion NT package. So that's not going to be enough for this round. There should be something new coming out to mitigate the loss that the small and medium enterprises has come to bear.
Jason Hsu, thank you, senior fellow at Hudson Institute. They're joining us out of D.C. And Dave, it's interesting, right? I spoke with the deputy foreign minister of Taiwan a few months ago, and you know the thing about chips, right? The leverage that they might have, as Jason mentioned, is certainly one thing that they're looking at, right? They have talked about this before, that if they actually see a higher tariff rate, perhaps it could mean less investment into the U.S. From some of these chip makers and exporters alike there. There is some sort of logic going on there. And maybe that could be a potential sort of more room for negotiations on that.
I mean, that could be, to borrow, no pun intended, that their trump card. The question is, has Donald Trump prioritized China? And
yes.
To some extent, maybe that has taken a bit of a backseat in terms of the broader scheme of things. For our Bloomberg subscribers, you can check out TLIV Go, by the way, just to get you up to speed, some clarity, nuance, and of course, amidst the new and fresh figures that have come out so far and some of the surprising ones to the upside there. Some of the interviews that you might have missed here also, you can check it out and commentary there, of course, on your Bloomberg terminal. Plenty more ahead. This is The China Show.
We're watching EMFX in Asia take a bit of a backseat today. Here, take a look at what the offshore renminbi is doing. It's that dollar strength, certainly, but on the back of these tariffs as well, you see the likes of Taiwan, that dollar there, breaking above 30. You have Korean won also passing 1,400 for the first time since May. So certainly it seems like to be an ongoing theme here, this dollar strength, Dave. Yeah, and, you know, when you look at Southeast Asia, that's certainly one part of the conversation. Thailand, for example, Cambodia in the headlines as well today, given these rates coming through on tariffs. In fact, Avril is back with us to talk us through this. Avril, what can you tell us at this point?
Yeah, I mean, it's really a range of levies that we're seeing across this 10-member bloc, right? I mean, on one end, you have the likes of Laos and even Myanmar. They have 40% in terms of rates. But I think one way of looking at it as well is when it comes to the bulk of the major economies like Indonesia, Thailand, Vietnam, they're all getting hit with 19%. And these are kind of countries that have been in the mix, the consideration in the conversation about curtailing the China Plus One strategy. And there have been criticism from Trump as well about the so-called Chinese transshipments. Although in the past couple of months, since this tariff ruction broke out, there hasn't been that much clarity in how this will be treated. That is still a key thing to continue watching. So for these bulk of these economies that are being hit with the 19-20% rates, another way of looking at it as well is how, you know, when it comes to Trump and these considerations, it's more about how there were just too many countries that had to be in the mix for trade deals or negotiations, and that's how they ended up with these levels. Aside from that, you had 10% for Singapore. That's on the low end of things. As I mentioned previously in our conversation, this is also because it has a trade deficit with the US, but it's worth noting that for a lot of these Southeast Asian countries, they are very export dependent. So it's also about the ripple effects that they're going to feel from the tariffs on their trading partners.
Yeah, and certainly, how does this hit China in some ways as well, as you say, given the trade flows there? Certainly one thing to watch. We're getting some more tariff lines here, Dave, on just last when it comes to Thailand, right? What are you seeing?
No, so this is from actually this morning here. I guess a context coming through here out of the Thais, right? So 19% is something that we figured earlier on was on the higher side of the expectations. But again, the framing coming through from authorities, to Avril's point just now, is this is a good thing. It keeps them competitive, but they might need to do other things to sort of offset some of the collateral damage. Avril, thank you so much. Avril Hong in Singapore for us. Plenty more ahead here on The China Show. All right, the Friday feeling, which is today's version of that, is not so much it's joy, glee, and jubilee. It's sort of get us to the weekend very quickly, get us to the deadline and more clarity on that. 0.5% to the downside. Broadly speaking, a lot of that is Korea, which is coming off lows, but as you can see, still a substantial pull. U.S. futures are coming off lows, and Hong Kong is about flat right now. So there is some reaction, make no doubt, but it is not a rush towards the exit at this point in time still.
We're still entering into a new trading month where there's still a lot of uncertainty. Yes, you have actual numbers in place now, but there's still a lack of a clear framework behind these sort of tariffs. And there's some arbitrary rates that are, as well. So does it add to just more unpredictability? It's hard to say that word here today. But yes, you are seeing at least the reaction to markets as risk assets are selling off, whether it is bonds, whether it is stocks here today. The dollar is seemingly the one that is the standout here. Is King Dollar making a comeback? Still to come, more questions there with Nomura as well. Gareth Nicholson joins us to talk us through these tariffs and what to look ahead to there. The eco impact with UVP. This is Bloomberg. If you just joined the show and thought we were going to talk about U.S. tech earnings, jobs report, stable coins in Hong Kong,
Apple suppliers,
you're wrong today. And we basically had to rip up the entire rundown here to really just focus on one thing. And of course, it is these array of tariffs that were just laid out in us last couple of hours there from President Trump and his administration there. So 10 to 15% baseline rates is what we said as we approach this sort of deadline of August 1st. But then again, there's some surprising ones that came out of this as well, right? We talk about 20% tariffs on Taiwan. You talk about 39% on Switzerland. And Canada as well, from 25 to 35. So certainly there's a lot to unpack here. And that's why you are seeing perhaps the Hang Seng starting to lose more ground here as we speak, because as Laura Wang from Morgan Stanley says, they're putting in doubt now the durability of this recovery, because we've moved on from the, as they say, overexcitement around anti-involution, Dave, to now focusing on softer macro data.
Yeah, and we were looking at exports, which were holding up the GDP numbers in China up until right now, and maybe perhaps even the next few months or so. That pillar of growth likely is going to be challenged, not just in China, but globally, right? And when you consider global equity markets are up 30% before the 5% drop that we've had in recent weeks to now, let's call it 25% from Liberation Day week, is that justified given now that there is a higher fence as it pertains to most trade going into the U.S. and some surprises to the upside, right? So Canada, will unpack that even further for you. So we are getting more lines coming through there, 10% tariff rate on energy. Potash is about 10%. That's reduced rate of duty there. But again, where do we land on Canada, which went from 25 to 35%? Global macro movers coming up on your screen. We're looking at declines across most parts of the Asia Pacific. It's hard to underscore. It's not all of Asia Pacific that's down. Right now you have South Korea, which is a capital gains conversation as well. It's also a conversation where that market has done exceptionally well, a lot head and shoulders above everything else. Southeast Asia is actually catching a bid. You can see Indonesia's coming online. Malaysia's up 1%. We'll talk more about that in a moment. Bond markets, bond yields are generally speaking on the way up. Futures are pointing down, and commodities as well, including gold, is also on the downside as I speak.
Yeah, so certainly there's risk assets are on offer here this morning, of course, as we start to digest more of this as well. There's so much talk about what else comes, right? Because, the Taiwanese say it's just temporary, the 20% tariff rate. They're not too happy about it. They probably want to continue on these discussions. Are those discussions actually, continuing, right? Because it seems like there's the three buckets, we'll talk about that a little bit later on, of how these tariff rates might have been laid out. And it really depends on, what sort of trade deficit you have, the U.S. has with that nation.
With that specific.
But then there's still a lot of things that we don't know, right? Sectoral tariffs, right? Particularly with Taiwan. We don't know what's going to happen with chips there. And then again, you also have the whole transshipment sort of thing here, and whether we see higher rates there too.
Yeah, sectoral tariffs. There's Brazil, obviously, which is a standout still.
90 days extended, yeah.
Yeah, and what is it? So, and it's also worth underscoring, right? We still have 2 hours until the deadline. So maybe there are still some conversations taking place. And then it's going to take, of course, 7 days before that takes effect, because they need that time, of course, to start collecting those tariffs. So far, and I have to underscore, so far, this is how things look across the Asia Pacific. And again, the word temporary is quite interesting, because how long is it going to be? Like, how long is temporary? And I think in about 90 minutes from now, the Taiwanese are going to be holding this briefing. So stay tuned for that. But yeah, let's help unpack these headlines and what we know so far.
Yeah, let's bring in our team. Bloomberg's Jill Desus and Min Lo joining us here. Avril Hong is in Singapore for us. Jill, I'll start with you. The dust seems to be settling now. But what have we learned so far, and really how these numbers came about?
Yes, Yvonne, well, as you mentioned, it seems like what the White House has done here is kind of pick about three buckets for different economies to really fall into. So the first is, this is what we've heard from a senior administration official. First is that there's this 10% tariff, roughly, and that's for places that run a surplus, that the U.S. runs a surplus with, a trade surplus with, right? And then you've got roughly 15%, that's what they're saying, that's where you've got the U.S. is running something of a trade deficit, and then larger ranges for any nation that runs a larger trade deficit with the U.S. So that's essentially the rationale that the administration is laying out for why exactly they've divided things up this way. But there's obviously a couple of, I think, pretty critical outliers here that we're looking at. David earlier mentioned Canada, that increase from 25% to 35% on goods. Obviously not something that Canada and the President Mark Carney are going to be necessarily happy with. But the one thing I will point out, though, on Canada is I'm not sure how much that increase from 25% to 35% will actually have, because remember, quite a few goods are covered under that UMSCA, that trade agreement that Trump signed during his first term. Plus, other goods are covered under separate tariffs, like steel tariffs and things like that, those sectoral tariffs that you kind of mentioned. So I do think that you've got to, when you're looking at the Canada picture, there was a report out from, I think it was the Bank of Nova Scotia last week, looking at the likelihood of a 35% tariff raise, and they ultimately said that when you're looking at the larger tariff picture for Canada, that's really only an increase of maybe like total goods covered under tariffs from the U.S. Maybe you jump from 5.5% to 6.5%. So remember, quite a bit exempt under that existing trade agreement. The other one that I'm looking at really here is Switzerland. I think 39% tariff on goods there. I think really steep. That's also an increase. I'd be really looking to see how that affects pharmaceutical goods trades into the U.S. And remember, I think as you also mentioned, Yvonne, the threat of additional sectoral tariffs also potentially affecting pharma. So, maybe that's another one to watch here. So, yes, certainly a lot on the table here, but those are a couple that really stood out to me.
Min, on the Taiwan side of things, what do we know?
Yeah, so the Taiwanese government has said that those tariffs are temporary. They are still looking to hold the next round of talks with the U.S. to lower tariffs. And in particular, they really want to get a favored rate on chips because, as you said, there has been the sectoral tariffs that are not yet announced that could potentially hit TSMC quite badly. And already that 20% tariff on Taiwan is really a disappointment if you compare it to some of their neighbors, South Korea and Japan, big rivals there, especially when it comes to the chip sector, getting just 15% tariffs. I think that's what Taiwan would want to be able to match. And of course, this is coming against the backdrop of the U.S. reportedly blocking President Lai Ching-te from stopping over in the U.S. on a trip, upcoming trip that was reportedly cancelled. And this is coming as the U.S. is hoping to reach a trade deal with China. And that really sends a signal of, is the U.S. changing its stance when it comes to, its relations with Taiwan here. And of course, this is coming as Taiwan has been trying to do a lot to appease the U.S., right? Closing some of these export control loopholes by putting a couple of Chinese companies like Huawei, SMIC on an entity list as well, pledging to increase investment in the U.S., but all of these still not enough to lower the tariffs.
Yeah, I mean, you could almost add the currency into it, although they denied it. right,
Yes.
of letting it allow it to strengthen. But yeah, then again, Min, thank you. We're getting some lines now from the president speaking to NBC right now. So they're telling NBC News he is now open to further talks with Canada, and he actually may speak to Mark Carney later on this Thursday night, but he also caveated that he won't make a deal with Canada before the deadline. So, they might continue, but maybe we might be yielding too much there. But certainly that is an update that we're seeing here between U.S. and Canada. Avery, I'll bring you in here right now. Let's talk about Southeast Asia. I think it's around 19% for most of these nations. Well, how is it being perceived?
Yeah, I think for the likes of Thailand and Cambodia that had been threatened with 36%, this is seen as a really good outcome. Indeed, you're hearing from the Thais, their business groups already saying that, this is something that, they can kind of take in, absorb, so to speak. And the Thai finance minister also kind of highlighted how they stand ready with measures to shield farmers, businesses amid all this. Overall, the view is that this will help to preserve their export base, the longer term economic stability, although there will be, I think, some convincing for Thai businesses and consumers given these tariff levels at 19% still because of, as you know, how the economy has already been struggling this year. One of the underperformers, if you're looking at their markets as well, they had been struggling to recover because tourism recovery had been lagging. So there's also this element of political instability in the country, which was sparked by the border conflict. It's part of how, these deals need to be taken back to businesses and consumers, that governments need to convince the public that these are good deals. We might see something similar for Cambodia, but as I say, overall, this is seen as a good outcome. If you look at the likes of Malaysia, though, we had been discussing, right, with the trade minister in May that 10%, would be seen as a good outcome. Now it's still getting hit by 19%. For some context, we have been seeing Malaysia as ASEAN chair this year being quite vocal about these tariffs. The Prime Minister had warned about this trade ructions, and we've also seen them hosting some Chinese leaders, including the Chinese president. So that's some context for what we're seeing at the moment. But overall, we are seeing it at least that we know what these levels are, what these economies are going to have to be working with.
Team, thank you so much. Avril Hong in Singapore, Min Lo here on set, also with Jill Jesus to help us unpack what we know so far and the clarity that is needed, given the confusion still out there. Right, coming up here on shows, we'll be speaking with Nomura and UBP on the markets and the economy and what this really means and what clarity we have right now to latch on to markets this Friday. Mostly lower, not a rush towards the exits. The dollar is continuing to see some strength after capping its, I believe, its best month so far this year in July, and still set for its best week in 3 years. Plenty more ahead. This is the China Show. Right, welcome back. So, yeah, it's Friday, and I was off yesterday, so my compass is a bit off. I mentioned Hong Kong GDP is coming out today. It came out yesterday, so that's on me. Anyway, it's backward-looking data, so it's not really that significant as far as the forward-looking element is concerned. That said, a lot will depend on where tariffs settle to determine really how we go with the economy here in Hong Kong. Bond yields, as you can see, are on the way up, generally speaking. Not across the board, but it's certainly a theme we've seen so far today.
Yeah, and when it comes to what the standout is, it still remains the dollar, right? The sort of reversal that we've seen in the dollar of late now to the upside, right? We're set for the best week in 3 years when it comes to the greenback. Obviously, the Fed meeting and all that kind of had sparked a lot of this as well, but all these trade deals as well is leading to a lot of these EMFX Asia sort of currencies to see a bit of pressure here, especially when it comes to Taiwan, the won as well. Taiwan dollar is above 30. You have Korean won at 1,400 levels here this morning. And we're still watching the loonie here, given just what happened with those trade talks there.
Yeah. Well, what do we do now? Right? The dollar's making a comeback. Equity markets are peeling back from 30% gains from Liberation Day. To help us answer those questions, Gareth, let me call you Nostradamus Nicholson is with us right now, CIO and head of discretionary portfolio management at Nomura. He joins us from Shanghai. Gareth, in case the viewers don't get that inside joke, of course, part of the conversations that you've sent us and talking points is you've sort of called the wall to this rally, and the pullback that we're seeing right now, given the headlines we are seeing right now. Are you now bearish in stocks? How does this change your short and longer term view?
Well, thank you, David, for that introduction. It's the first one like that. I like it. Realistically, the signals were pretty clear. You're going into the end of the month. We've had a fantastic run, as you highlighted, since Liberation Day. Even the one-year numbers up 16, 70% on the S&P. This has been a very strong rally, given all the uncertainties. It makes a lot of sense for traders, for dealers to take some money off the table, going into non-farm payrolls today, going into what we knew was going to be tariff announcements tonight, and the 1% pullback, I think, makes sense from a prudent investor perspective. It's something we expect to see some headwinds for equities over the next few weeks, but that's short term. I really do believe for the longer term we can still see a further grind up from here. Earnings fantastic. There's a number of drivers we can chat about for the more medium longer term.
Okay, we'll get to that in a second. I want to get you to take on tariffs, right? You mentioned here, is this executive order a pothole or the start of a trade war sequel? How are you digesting some of these tariff levels now around the world?
Well, Yvonne, I'm diving into the basic numbers I can understand. We know 2024, it was around about, the average tariff rate from the US was about 2.5%. Now, since this latest announcement, we've gone up from about 13% to 15% average, which is a big jump, but it is nowhere near as scary as some of the numbers we were expecting previously. We do think that the current framework for corporates in this environment has been working. Move production, work on passing this to the consumer, and generally speaking, earnings show that this has been successful. So at this current level, 13 or 15, the multiples for the earnings are going to remain pretty solid until we start seeing this flow meaningfully into inflation, and that's not the case just yet. When we start seeing inflation above 3% and sticky around there, then we could start seeing further material weakness in the equity markets. But at these current market levels, given the macro backdrop, and we think, from payrolls and the other numbers we can chat about are pretty constructive, this is still a strong equity market for the medium to longer term.
Yeah, and Gareth, I guess on the earnings front, you mentioned multiples, right? So I guess in some ways this addresses some of the concerns over higher multiples at this point in time. I guess the follow-up question I have then is this earnings season and how good those earnings were and how broadened now that we're seeing across this earnings story in the U.S., is that now a risk for other equity markets which have done well?
I mean, we're walking a valuation tightrope, definitely, David. Earnings are 6.4% above expectations. It seems most of the big names have done well. So a lot of the breadth is increasing, so it's not just the big names. Generally speaking, this is constructive for an environment. Now it's 22 times PE ratio in the S&P. That's expensive. It's 1 standard deviation above the long-term average, but it's not super expensive. For it to grind higher from here, you need a strong macroeconomic environment. And the tricky bit is, as we know, there is lots and lots of factors driving the macro picture at the moment, be it how the one big beautiful bull plays through, the fiscal gambles around that, pressures around the long end of the curve, more news around the tariff. There's a lot of potential potholes to slow this economic environment down at the moment, but give the benefit where it's deserved. The economic picture is robust. The earnings numbers are coming through robust. We believe that this, at the moment, is the right position to continue with a grind up in equity prices, use the dip to add into high conviction sectors, much more about sector specific value here than just the broad index, in our opinion. And I think this is highlights that we need to be particularly active in our trading in this environment to maintain that robustness, to remain that low drawdown. It's going to be an eventful remaining part of the year, but still profitable.
Gareth, I got to ask you about the dollar. It seems like right now we're seeing a bit of breakout here right now. And up until recently, it's really been a currency that's been divorced from rate differentials, divorced from everything else. What do you think is going on now? Are we kind of coming back to a new normal or the old normal for the dollar?
I like the new normal in the sense that, as you highlighted, it was the most hated trade for the last few months. It's really been, some of the headlines that have come out have been so damning of the poor dollar, from king to zero. But I don't think that's realistic. I think that's just the market, jumping on the wave and riding it maybe too far onto shore. This will come back to a level that is the new normal, using that narrative. I think there is a trend for lower dollar, for weakness over the long term. I think this correction is probably, rightly so. It just got too weak too quickly. So for us, we still prefer diversifying out of the dollar to a reasonable level. A lot of our portfolio, a lot of our clients have had a huge concentration in the dollar over the years, 70, 80, 90% of their assets in dollar exposure. That has worked, but we've been highlighting from the beginning of the year, we want to diversify that into a more sensible number, look at other currencies, other asset classes, and this will just give more opportunity for our clients to rebalance it and build an even stronger, more resilient portfolio.
Let me bring in, the U.S. 10-year yield, the bond market yields. We've had inflation overnight. We had the Fed this week. Jobs are coming up out of the U.S., Gareth. And I guess my question is, at what point do you think, or will they get to a point where rate differentials will matter to those clients who are probably diversifying, to your point, away from the dollar? At what point do they go then ask you, hey, there's some positive carry there, and what do I do with that information, Gareth?
Yeah, I think that's key. Like you said, we're around 438-ish level. If you think round numbers, we want to get paid for these risks. You want sufficient carry. Anything north of 450, I think you're starting to get paid for the kind of uncertainty that we're seeing at the moment. I think it will still drift higher until we get to a point where investors, depending on their level of needs, will say, okay, I'm getting paid, the carry's there, but I still think it's going to go further from here. I would only really start looking personally around the 4.5% from the 10 years. I think that's a level in the sand where you can start trying to balance out your carry, your income, your growth. At this level, there's still a lot of uncertainty. We're going to see payrolls come through. We've got a lot more inflation prints. As we know, the hard data is holding up well, but the soft data, the surveys, the sentiment, that's still very weak. And we think there's going to be a convergence where the hard data is going to get weaker and maybe the soft data gets slightly stronger, and we'll meet somewhere in the middle. But from a carry treasury perspective, we think yields still higher from here.
Yeah, we still have 2 inflation prints, 2 labor prints in the U.S. before that September meeting for the Fed, so certainly one to watch. I got to get your take. You're in Shanghai, Gareth, so what your take is on this China equity rally, which seems to be petering out right now. Morgan Stanley had an interesting note saying there's been maybe too much excitement over anti-involution, and now we're starting to see, the data, and the macro data start to turn soft in China. Does this rally now, is it in doubt?
I think, for us, the China rally has been a technical rally with regards to fundamentals still need to show support. The stimulus still needs to really gain traction for this to be a long-term, very bullish conviction. At the moment, we're playing more tactical, as highlighted, but on the ground here in Shanghai, visiting some of the big exhibitions, some of the AI innovations, some of the factory automation. The innovation is so strong. The amount of people involved and exhibitionists, the visitors, there is a lot of good energy here, a lot more energy than I've seen, same time last year. So I feel more constructive personally just on the ground here. And I think as we see the macro picture and the stimulus play through, that rally will come back again. At the moment, on a technical aspect, we are watching very much the momentum. We're lightening up risk when we see the bumps increasing. But again, for medium to long term, remain constructive Chinese equity. I think this is a space that's got a lot of legs. A lot of the right moves are made on the longer term, but in the short term, it's going to be volatile, and we want to trade it pretty actively.
All right, Gareth, we got to go. Gareth Nicholson, CIO and Head of Discretionary Portfolio Management at Nomura. Have a great weekend. And still ahead, UBP joining us to help unpack how this new U.S. tariffs and the like will shift global trade. Carlos Casanova joins us next. This is Bloomberg. All right, there is an NDRC briefing that's happening in China here this morning, and we're hearing a little bit more about them, talking a little bit more about over-competition. So China to name and shame typical cases of over-competition, also to strengthen the policy support for computing power. This as they talk about deeper integration of AI and economic development. So that's certainly what's been focusing on here today, obviously this whole anti-involution theme. And really what we got from that Politburo meeting was this stress on really trying to rein in overcapacity in parts of this economy. CSI 300, we're slightly above water there. This is Bloomberg. .29 a.m. in Tokyo. Japanese markets are going to that lunch break here right now, and we are to focus on what's been going on. It's a bit of two sort of stories in the equity markets. The Nikkei is down, Topix is higher. We're up about 0.4% for the Topix there. Dollar yen's at 150, so a little bit of weakness there, just reflecting that dollar strength we've seen of late as well. But yes, that is the latest when it comes to Japan. Of course, after we had that BOJ meeting yesterday, Dave.
Oh, yeah.
Oh, yeah. You weren't here for that.
What happened there?
Nothing.
Nothing? Okay. There we go. Good day to take off, actually. Well, there's a jobs number that's coming out later today. So at about the time, Yvonne and I will probably be asleep looking at our lifestyle choices these days.
Yes.
8 p.m. is stretching it. Let's have a look at markets right now. So it's, notwithstanding, it's an extremely busy news day. As Yvonne is pointing out, we've torn up the script. Going into the show, we've been tearing up scripts as we go along. 0.4% to the downside Asia Pacific. We are still, by the way, counting down to the end of that deadline, which is in about an hour and a half, give or take, and then 7 days after that, and when things take effect. By the way, this time in the next hour, stay tuned for Taiwan and the press briefing that they have said they're scheduled to do 11:30 local time. Right. Some of the initial takes on. Well, more clarity on tariffs right now. So higher tariffs will be cutting growth, will boost inflation. Our folks at Bloomberg Economics, and let me just paraphrase this, if the new settings take effect as planned in about 7 days or so, including some of the assumptions on your screens, EU, Japan, and South Korea stick, we're looking at a pickup from 13.3% average tariffs in the U.S. to 15.2%. That's up substantially, get this, from last year, which was in low single digits. So what does this mean for not just the U.S., for global shipments, for inflation down the road? Let's get a sense of that with Carlos Casanova, MD and Senior Asia Economist at UBP, who's had to tear up part of his morning plans to be with us today. Thank you for coming in fairly last minute. But yes, we're all yours. Where do we start? What's top of mind as you've seen all these rates come through this morning?
Well, we knew something had to happen, so he's already delayed the deadline twice. And some countries have been more proactive than others in trying to secure a trade deal, even if the details of those trade deals are not fully announced. So we were expecting him to do something, especially vis-a-vis the laggards, so China, Mexico. We were expecting those tariffs to be high for India as well. And we have visibility as to what the new world trade order is going to look like going forward. So I think market is definitely, of course, going to be a bit choppy, but in the long term, with that visibility is going to help markets to price in the outcome of US CPI, US GDP, and what to expect for earnings going forward. So it is in line with what we expected, and I would say not the end of it. So we should still see some deals come through before the end of 2025.
How you do the tariff math now when it comes to the impact on either profit margins or whether some of these companies can pass on to consumers? I mean, what are you looking in terms of maybe the inflationary impact to all this now?
Okay, so we have now average tariffs that are around 15%. I believe if you take in the previous tariff levels, we are looking at slightly higher than that. Depends on how you calculate the trade-weighted average. But it's going to be between 15 and 20% compared to just slightly above 2% prior to Liberation Day. And Trump is going to be using those revenues to support his domestic agenda. So that is the end game here. He is going to push forward with his big, beautiful bill, with Project 2025, and tariffs serve a purpose to A, finance that agenda, and B, extract concessions, including geopolitical concessions, from some of these countries. In terms of, and it's a risk, the risk-reward is there. So they've calculated, yes, we are going to see some upside on inflation. Yes, it's going to trim down GDP, but it's manageable. And the market is now a lot more complacent about that tariff level than it would have been prior to the announcement. So we are looking at a pass-through on CPI to around 3.5%. It remains a big question mark for the Fed. Will it stay at 3.5%, or will it go back down to 2% over the coming 1 or 2 years? We think that it will go back down because countries are going to take cues from the China playbook to try to absorb partially the cost of those tariffs, and it will drag on U.S. activity, we think, in the coming months, once you start to feel the impact of tariffs. But it's still a soft landing scenario with inflation remaining within a reasonable level that they sort of calculate that it won't really derail their agenda. So that's kind of the end game here.
Yeah, it's interesting how you put that. It's almost a transfer of growth from U.S. exporters to the U.S. to, fiscal pump priming. And I think Jay Powell even mentioned that during the Fed press briefing. He alluded to how much they're actually bringing in a month because of the time. 30 billion, I think, was the revenue. So my question is, if you could elaborate more on that, how are, these countries now that are exporting to the U.S. that now can't count on future exports, how do you think they'll manage to salvage or offset the slowdown coming through over the next, let's call it, year and a half?
Well, we should see support for exporters still. So we should see tax cuts and other subsidies for exporters. China did that very successfully. We should, the theme for the remainder of the year with all of this uncertainty is broad dollar weakness within some limits. But going forward, I think you are going to see countries in Asia, you are going to see China trying to lower the trade-weighted level of their currencies to preserve some terms of trade and try to offset that cost. But you are also going to see countries pivoting more aggressively towards domestic demand through a combination of monetary policy cuts and fiscal stimulus. So fiscal really is taking over from monetary. But in Asia, we are not in a pause yet. The ECB has paused, the Fed has paused since December, looking to cut again in the fourth quarter. But throughout the first half of this year, in Asia, we continue to cut interest rates, and that's going to be supportive for growth, I think, all the way into the first half of 2026. So we expect some of these banks that started a bit later, Australia, Malaysia, to continue to cut rates into 2026. And that's going to support a more aggressive pivot towards domestic demand to try to offset the decline from U.S. Final demand.
How are you deciphering between the haves and have-nots? Who's going to be coming out of this better? Who's going to be the biggest loser?
We continue to like countries that are more domestically oriented. So the Indias and the Indonesias, they are better positioned, I think, structurally to benefit from this new trade order.
Even with 25% tariffs for India?
Even with 25% tariffs for India. And we can discuss India in more detail and what role that negotiation serves. But in the short term, there are markets that were hit heavily and that are very export dependent, and with the improvement in visibility are going to rebound more aggressively in the near term. So countries like South Korea, for example, we've seen a lot of upside year to date. That continues in the context of now we have visibility and tariffs have been lowered to 15%, including for auto exports. But sort of the medium term view is that domestically oriented economies benefit.
I think if you look at, you made a very good point before we started, the missing pieces to the puzzle are very large economies, right? Brazil, Mexico, China, India, we're not even sure of that, for example, to your point. Do you think the outcomes for those will have a material impact on how we eventually land in terms of effective tariff rates in the U.S., for example? Is that going to be material, in other words, moving forward?
100%. So I think if we don't have an outcome in Mexico and China, those are the two largest exporters to the U.S., certainly we could see some upside risks to tariffs and U.S. CPI. Our current baseline scenario is that we should. So we expect that President Xi and Trump will meet around November, following the APEC summit in Korea. That should pave the way for some sort of deal. We have seen from Korea and Japan that you are able to sign a deal agreeing on an average tariff level with some of the other details remaining to be confirmed. For example, who is purchasing U.S. goods, who is investing in the U.S. Those details can be ironed out later. So I think it is possible for these big economies to strike a similar type deal before the end of the year. And that should hopefully pave the way to that scenario where inflation in the U.S. is capped at 3.5%.
Carlos, it's great to have you. Carlos Casanova there, MD and Senior Economist for Asia at UBP. And subscribers can also turn to the terminal for more on this. T-Live Go has been on fire this morning. It's your function for the latest updates, commentary, analysis from our expert editors. Plenty more ahead. This is Bloomberg.
Southeast Asia seems to be a play today. Is this a hedge against the uncertainty out there? Is this repositioning? Is this us in this part of the world at least escaping worst-case scenarios? Thailand, of course, has been a very big topic of conversation this morning with the tariff rates there and maybe what that means, right? In fact, our colleague John Cheng has put out this note going into today. I should also note that Southeast Asian markets and global funds have been coming into this market, specific market, perhaps as a play and as trade fears fade, question mark. Now, on the Thailand part of the conversation, it's 19%, the tariff rate on goods from Thailand. We have the finance minister coming out and talking about how that 19% is a competitive rate that can boost investor confidence. Let's bring in Patpicha Tanakasimpipat in Bangkok for us to talk us through whether or not this is it's clearly being framed as a good thing, 19%. What are you hearing on the ground, and how does that resonate among the business community there, Patpicha?
Definitely, David. Thailand is framing this as a win, for sure, for the 19% rate that we got, because it is within a range that Thailand previously expected and also in line with regional neighbors like Indonesia, the Philippines, and Malaysia, which all got 19% as well, and Vietnam, which got 20%. And that really is the key, because the Thai Finance Minister, Pichai Chunhavashira, said that having a rate that is in line with neighbors will help keep Thailand stay competitive as an exporter and a regional manufacturing hub, and will also boost investor confidence. And that sentiment is also echoed by various business groups as of this morning. The Thai Chamber of Commerce expressed a similar sentiment on that as well.
Yeah, and it seems like this peace deal with Cambodia certainly helped them in some ways. Tell us a bit more, though, now that we have an actual tariff rate of 19%, what is at stake for the Thai economy?
Definitely. The U.S. is Thailand's biggest export market and accounted for 18% of total shipments last year, Yvonne. So there's a lot at stake for the Thai economy, especially as the Thai government has been grappling with all sorts of domestic issues at home, including a political crisis involving a suspended prime minister, as well as the border clash with Cambodia that you just mentioned. As for the economy, the Bank of Thailand previously in June made a forecast that the Thai economy would grow by 2.3% if it gets an 18% tariff rate. And also the finance ministry previously revised down a GDP forecast for the year from 3% to around 2% based on the tariff risks. So it seems more or less in line with what Thailand has been expecting and thinks it can manage. So we'll now see how the real change happens on the ground and how the government plans to shield the businesses and farmers from fallouts of more U.S. imports into Thailand.
Patpicha, thank you. Patpicha Tanakasimpipat there, our Bangkok Bureau reporter, joining us with the latest on that, on Thailand here. And of course, on Thursday, today, President Trump also announced a planned levy at least 25% on Indian exports. I should say yesterday. I forgot what day it is already here. Tata Steel CEO spoke exclusively with Az about how they're mitigating global tariff risks.
It's still early days. We are waiting to see the details. Obviously, from a Tata Steel point of view, there's not much of an impact because we don't really export much from India to the U.S. We export more from Netherlands and UK to the U.S. As far as Indian industry is concerned, I think, yes, there is a fair amount of exports which goes to the U.S., engineering exports, also pharma. So there are many sectors which are impacted by this. But let's wait and see what happens over the next few days.
As you suggested, Tata Steel and other steel makers in India are not really impacted because of the lack of exposure. How about indirect impact, maybe Indian downstream sectors, businesses, for instance?
Absolutely. So there is a fair amount of engineering exports which goes to the US. That will have obviously some impact on the steel consumption in India. But largely steel consumption in India is driven by the domestic consumption, basically in construction and automotive. So I don't see the indirect impact on the steel industry also to be significant in India.
How about your own overseas business? Might that be hurt in any way?
Yes, that is getting impacted because we have a significant operation in Netherlands, which exports about 10% of what they produce to the US. So as far as what we know, it's still 50% duty on steel exports from Europe to the US. Notwithstanding the recent agreement that they've signed. So we are again waiting clarity on that. Some of it is obviously impacting our customers in the US because some of those steels that we sell from Europe into the US is not made in the US. So they have no option but to import, and so some of these costs get borne by them. From the UK, where also we have an operation, again, about 5% of what we produce there goes to the US. There, the UK has struck a deal with the US on a 10% duty, so we are better off there than we were or than we are in Netherlands.
But is there a sense of how much you'll be impacted? Can you quantify the impact, especially for your business in the UK?
Yeah, so I think these are, like I said, 5 to 10% of the volume, but maybe about 15 to 20% of the profitability of the businesses. So while there are mitigating actions, like I said, in some cases we are able to pass on some of these costs to the customers in the US. But in other cases where we are not able to pass on those costs, we are looking at alternate markets where we can sell the same products. Because what we sell into the US are basically high-end steels. So you need to replace them with high-end steels for other markets and not substitute them for the commercial grade steels, which are easier to sell. So the mitigation actions are going on. So the overall impact, mitigated impact would be much less. But if we didn't do anything, it would have had an impact on the profitability because they account for a larger share of our profitability than the volumes.
You talked about mitigating some of the impact. How are you mitigating in terms of countering volatility that is expected to accelerate from here?
So you would mitigate by looking at other products which are similarly profitable and other markets, whether in Europe or elsewhere. For instance, the Middle East is a growing market for some of these steels. So we're looking at Middle East, we're looking at Latin America as a market. So we're looking at other markets where there is a requirement for these high-end steels and where we are not impacted by these kind of tariffs.
And that was the Tata Steel CEO, TV Narendran. They're speaking exclusively with Bloomberg Insight anchor Haslinda Amin. We got plenty more ahead. This is Bloomberg. All right, we're tracking something that's going on here. There was a statement on WeChat that was coming through from the China National Cyberspace Administration on recent cyber attacks. Now, this seems to be alluding to U.S. intelligence agencies that have frequently carried out cyber attacks on China's defense and military industries to steal secrets here. So that is the context of what we're seeing. And U.S. agencies use the Microsoft flaw in these attacks. How Microsoft gets put into all this, Dave, obviously there was that hack with SharePoint recently, and the U.S. have said, China and some groups there may have been responsible.
Yeah, so this is the other side of that, and I think the full statement, they just put that out on WeChat, I believe is the full statement there. Okay, so that came out about 20 minutes back as we were covering all of the latest on trade and tariffs. Also taking place in the last hour here is this NDRC and some of the news lines that have come through. And I think most noteworthy here, I would say, among the many things, including, a policy support for computing power and the trade-in subsidies, and we have a number for that right now, 69 billion RMB, that's for October, is a push and a focus toward curbing excessive competition. So a couple of things. China will regulate market price order in a powerful manner. They'll be guiding companies to make rational pricing, naming and shaming typical cases of over-competition. Whether this is related to the news lines that have come through, Meituan has come out with a statement just now. They're promising to curb disorderly competition.
Okay. How is certainly the big thing. Certainly when it comes to the food delivery side of things, most analysts that we talk to say this whole anti-involution theme is not going to benefit Meituan and the like because of what needs to be done, whether it's helping merchants or helping those on the other side of things. So certainly that's one thing to watch. We're also watching this press briefing that's going to be at the bottom of the next hour here in Taiwan and how they are going to be talking about that 20% tariff rate from the U.S. Yeah, that starts 11:30. 38 minutes from now, local time. So stay tuned for that, of course, in the next hour of Bloomberg Television. And keep in mind, it's 30 minutes to the end of the deadline. And then from that point, you count 7 days. And all these tariffs that have been announced, and perhaps more that will come, will take effect around this time next week. On that note, that's almost it from us here on Bloomberg TV. On the China show, just to mention, when you look at markets right now going into the rest of the session today, is we still have the jobs report coming through. We're still feeling the after effects of this reversal higher in the U.S. dollar, set for the best week in how long? 3 years?
3 years, there we go. And a Chinese equity market that seems to be actually holding up this Friday.
Yeah, it seems to be kind of bucking, the rest of the trend here right now. Perhaps this whole anti-involution theme does have a bit more legs there today. You take a look at how Hang Seng is, though. We're actually slightly lower now, about a third of 1%. So still, we'll watch very closely Taiwan dollar, right? We're now above that 30 level there for the currency. And certainly what they say, right? Obviously, our guests have said 20% is bad. From a headline sort of way of looking at it, if you compare it to the likes of Japan, likes of South Korea, that both got 15%. How are they going to spin this? They keep saying it's temporary, right? So they're hoping there's a 7-day window now to maybe keep those talks going until these tariffs go into effect.
Yeah, we'll see on whether or not what their trump cards are, no pun intended, as far as Taiwan is concerned. So how they're framing it is actually important, because a market that comes online in the next hour is Thailand. And what they're saying is, well, 19%, that's actually a good thing that reflects a competitive, that's at a competitive enough level for the economy to grow over in Thailand. And of course, the finance minister is framing this as a win. So far, Taiwan, that hasn't seemed to be the case, temporary, and we'll see how those conversations go.
Yeah, and there's still so much to deal with, right? I think we're still trying to figure out what India and what they're going to get out of this. We still have a U.S.-China deadline that's happening on August 12th as well. Canada.
Oh, we haven't even started with Brazil.
Plenty more to come. All right. Have a good weekend. Stay with us.